Everyone's talking about the proposed 50-year mortgage. While it's being positioned as being able to help with affordability, when you run the math, you can see that it does the exact opposite. Let's break it down. If we haven't met, I'm Rebecca, aka the Mortgage Mentor, and I take my years of experience and knowledge and share them so people understand what to do with their mortgage, what's going on with the housing market, and in this case, how viable 50-year mortgages are. Be sure to subscribe, like, and comment. Let's get into it. So on Saturday, September 8th, Trump posted this on Truth Social, and then the head of the FHFA, who sets the guidelines for conventional loans, and then Pulte retweeted it and said, yes, this is something that we as the administration are working on. The idea sounds simple. Take a 30-year mortgage and turn it into a 50-year. Stretch out the payments and boom, a whole lot more people can get approved and with lower payments. It sounds great until you realize that every fix comes with a cost. So let's get into the math. Let's say that you have a $400,000 loan at 6.5% rate. On a 30-year, your payment's gonna be $25.28 a month as far as the principal and interest payment, and you'll pay about $510,000 in interest over the life of the loan. Now, if you're looking at that as a 50-year loan, your monthly payment drops to $22.54, so there is a little bit of savings there, but you're going to pay over $950,000 in interest. So it's about a $274 a month savings for over $400,000 more in interest over the life of the loan. Now, one of the things is that people are saying, but I'm not going to keep a house for 30 years. Who keeps a house for 30 years? Historically, we don't. So it's not so much about being able to pay off the mortgage or taking 50 years to pay off the mortgage, but it's the stretching out of that interest and almost doubling the interest that you pay that can be so detrimental. So it's kind of like getting excited about saving $50 on your car payment, but paying for that until you retire. Some people are saying, what if this helps Gen Z finally afford a home? And here's the thing, if it just lets people buy more without fixing the inventory problem, not having enough homes, then home prices are going to continue to rise. Because it's that combination of supply and demand, if you create even more demand by making these mortgages cheaper, even though you're going to pay them for forever, then home prices are also going to increase. We saw it in 20 and 21 when rates were crazy low. And that's really what those low interest rates in 20 and 21 that made it so easy to borrow are really what played a big part in home prices increasing as fast as they did and as high as they did. So it doesn't really make homes more affordable. It just makes the debt last longer. Now, proponents will say this will help more people buy homes. But like I said, here's the problem. When you make borrowing easier, prices rise to match it. We saw it in the lead up to the 2008 crash, and again, we saw it in 20 and 2021. 2008 was caused by looser credit, wider guidelines, really funky, weird loans that were out there that put people into bad situations that they couldn't get out of necessarily. And 2020 and 2021 were because of crazy low rates because the Fed was trying to basically save our economy. So the affordability doesn't really improve, it just shifts the numbers. So you might have a loan where, yes, your payment is lower, but perhaps you're paying more overall for the house because now there's another rush for people to try to get into home ownership because of that affordability of, again, a niche type mortgage program. And that really leads into the crux of this, which is you don't fix housing by, longer debt or easier debt. You fix it through inventory, through more homes. So some people are asking, isn't this just kind of like rent? And kinda. Because with a 50-year loan, you are stretching that interest out, you are stretching out that repayment over decades. And while you technically own the home legally, you're not really building equity fast, which is part of the benefit of home ownership is building equity. So it kind of feels a lot like renting from your bank. So what's going to be the real impact of this if it comes to fruition? Because let's be honest, a lot has to happen before it would come to fruition. Right now, we already have options for 40-year mortgages and interest-only mortgages. They aren't widely used though because the agencies that securitize mortgages. So basically they take the mortgage, they turn it into a bond, they give the money back to the lender so it keeps the flow of money going around. When a mortgage is outside of that securitization process, which is what Fannie Mae and Freddie Mac do, then you are dealing with most of the time what is called a non-QM or a non-qualified mortgage. So 40-year loan and interest-only loan, usually you're going to be following into that non-QM type bucket, which because there's higher risk, longer term or interest-only, not building up that equity, then a lot of times that also carries a higher interest rate or a higher down payment. So it's not going to be the fix that it's made out to be right now. But as far as for what the real impact could be, I certainly understand Gen Z, is probably out here feeling like, great, I'll just be paying my mortgage until I'm 77. It feels a little defeating for sure. My real concern is as far as around the equity erosion, just from the standpoint of taking so long. I think I looked at a chart, I've looked at a lot today, but looked at a chart that said it's going to take 10 to 12 years to build up any kind of real equity in a property if you're making that 50-year mortgage payment. So again, equity erosion, slower equity growth or slower wealth growth, because that could certainly be an issue if someone's in a home for a few years, maybe in kind of that 3 to 5 range, and they want to go and sell their home. Well, now with their seller transfer taxes, closing costs, all the things that sellers do pay, if they choose to use a realtor, many still do, because it does typically help you get your highest price and great representation on a very large financial transaction. So if you're also paying realtor commissions, there is the potential for where somebody may go to sell their house, and with what their mortgage balance is and not a lot of equity and the fees that are associated with selling their house, they might be upside down. We've also seen that before. We saw that in 2007, 2008, 2009 with, short sales. It's not good for the housing market at all. It's just not. If the goal is ownership, then yes, this does move this closer to making home ownership easier, which is a good thing, but it really is turning into a lifetime of renting. And that doesn't benefit average Americans, that benefits the banks and billionaires. So when it comes to proposing this 50-year mortgage, again, we already have interest-only and 40-year mortgages available. So why aren't we using those first? Why would we jump all the way to a 50-year when we have some other mechanisms in the industry that maybe could have some key components of them change, so maybe the down payments don't have to be as large, whatever the case may be, but it doesn't really make sense to shoot for the moon with a 50-year mortgage when other products already exist. And some people have said, well, don't other countries have longer terms, like 40 years, 100 years, whatever? In places like Switzerland and Japan, housing markets and lending systems are simply structured differently. Often there's lower population growth or there are government-backed rate controls. Our market doesn't work that way. It's built on resale and investor demand, so longer debt just basically pushes up demand and it feeds higher prices. So when it comes to housing, we have a systemic problem, and this is a short-term solution. If it becomes mainstream, this is what's going to likely happen. Prices creep up, borrowers borrow more for longer, and the same affordability gap remains, now just with more zeros. The bigger issue here is housing supply. And to address that, we have to deal with bigger issues like zoning laws, cost of materials, labor availability, and just housing policy in general. But that's harder to fix than just say, here, stretch the loan out. So the 50-year mortgage is kind of like a Band-Aid for a broken arm. Some are saying, hey, at least the 50-year mortgage gives people options. And sure, options are good. But when the option is more debt for the same house, it's not progress. It's just another patch instead of a solution. From the standpoint as far as kind of a reality check on all of this, if $300 a month makes or breaks you getting a house, that's not really a math problem, that's a market problem or a budget problem. So before you get excited about new programs, maybe ask yourself, does this actually make home ownership easier or does it just make selling homes easier? Ultimately, for us to address our issue of housing affordability, we need to look at real solutions and not just flashy fixes or headlines. And one more that I've seen, isn't the 30-year mortgage already a bad idea? You already pay a ton in interest. And it depends. For most people, the 30-year gives balance. You're able to build up your equity while, still keeping the payment reasonable. Stretching that to 50 years though, it just means that you're compounding the least effective part of the loan. Let me know your take. Is this a creative idea to help people become homeowners, or do you think that this is a trap disguised as opportunity? So I'd love to know what you think, and I'll see you next time.